Welcome to Jazz After Dark. Are we ready to do this? Yeah, we're ready to do this. Tonight, my wife actually made me a beautiful old-fashioned with, can you guess, Buffalo Trace. A little orange peel in there. Ooh, and she even squeezed the orange peel. Very citrusy, very good. We never had an old-fashioned with a Buffalo Trace. It may be a little unconventional or new school, but very, very good. We are financial advisors here at Jazz Wealth, and this is our time to just sit back and teach you something maybe a little bit new or in more detail rather than the daytime videos that are all fast and whatnot. But I got a short one for you here today. It occurs to me that many people, as we get to the end of the year, are not entirely sure how capital gains and losses work. So I'm going to go through this very simply. I'm going to give you some examples, and I'm going to do it with the diagrams and everything, just so, typical jazz fashion there. We'll make it real simple, but I'll show you the details as we go. All right, here we go. That old-fashioned, by the way, is a solid, 89. Very good. I don't know if I'm looking for sweetness today or what, but gorgeous. Anyways, short-term capital gains. I put both of them on there for you. If you're single or married filing jointly, this is your tax brackets. When you hear the word tax brackets, that's what we're talking about. Remember that our tax system is not a fixed tax system. It is a tiered or graduated tax system. So if you were to, I think I have an example. There you go. If you were to have income of $100,000, then let's say you're married, okay? So from nothing, or from $1, it should say, to $20,550, that portion gets taxed at 10%. And then the rest at 12%, and that should likely take you almost all the way up there. And then you've got 22% and so on, the more money that you make. Oftentimes, you'll see the tax brackets rated as, at the 10% bracket, you pay $2,550. At the 12% tax bracket, you pay $2,550 plus 12% of the excess. It's another way of saying it, but that's how they have it there. So we're talking that there's a couple terms that you'll hear. First of all, we have a tiered or graduated tax system. Then you have your marginal tax rate, which I believe is on the slide there. Yeah, so you have the marginal tax rate and your effective tax rate. So let's say you made, you made $100,000, right? So your marginal tax rate or your highest tax rate, just raw numbers here, no deductions or anything being figured in, just let's go with this for a second. Your highest tax rate would be 22%. Or we might say your marginal tax bracket is 22%. Your effective tax rate is something less because you paid some tax on 10%, some at 12%, some at 22%. And so my example, I'm saying your effective rate is somewhere around 18%. So when people say, I'm in the 24% tax bracket or whatever, that's their top marginal tax rate, right? Simple so far, right? If you're single, you just use this bucket over here. Same thing. Now, when we're talking about short-term capital gains and long-term capital gains, this is where the confusion starts. Short-term capital gains are taxed just as if you went to work and you earned it, as if you made an hourly wage, as if you made tips, as if you made a salary, things like that, a bonus. Let's put that aside for a second. So short-term capital gains on stock are just as if you earned the money. So now a short-term capital gain is anything that you held less than 1 year. And the clock, by the way, starts the day after you buy the stock. It does not start on the day you buy the stock. You buy a stock today, your clock starts tomorrow. And if you hold it for a period of 1 year or less, then you pay short-term capital gains or losses. If you lose within that time period, it's the same thing. Now, the tax code really favors long-term investors. And they do this by offering a separate bucket at the moment. This is how they do it. And so your long-term capital gains rates are calculated like this. Now, this is not a tiered system. This is, for example, if you have $100,000 in long-term capital gains, income plus long-term capital gains, you would pay a flat 15% on the capital gains. So let's do an example. Do I have an example? I do. So if in this example here, you're married and you filed jointly, as the example we used before, and your regular income is $200,000 between the two of you, and you had a stock that you held for over a year and a day, and you made $30,000 on it. We've got standard deductions and everything in there, but at the bottom line is that you would pay on the $30,000, you'd be in the 15% bucket. You are not 0% for the first X number of dollars, then 15 for the rest. And I should point out, this is a number that's calculated with your income plus your long-term capital gains. You put both of those into a bucket, and wherever you land is what you pay on your long-term capital gains. So if you're a high earner and you make $500,000 and you have $10,000 in long-term capital gains, then you're going to look for $510. Where do you fit in? You fit in right here. The $10,000 in capital gains, you will pay, in this case, 15%. And so here's kind of the breakdown of that there. So your ordinary income, you've nearly gone up to the 22% tax bracket. Your net taxable income is $174, but you would still pay the 15% penalty on the $30,000, or 15%. That would be your tax estimate there for what you would have to do. So far, so good? You guys with me there? Now, that's the easy part. The next part that people get confused on is the difference between when I have a short-term capital gain or loss and when I have a long-term capital gain or loss. How do those two things work together? And thankfully, there's software that does this these days, but here we go. I just tried to put this in kind of an order. First, you take your net short-term losses and gains. In other words, you bought stock XYZ and you made $100. Let's say you bought it and sold it again in the next month. So it counts as a short-term capital gain. Then you bought stock YZX and you lost $200. So your net short-term loss of positions you held less than a year is a $100 loss, right? Now we go over to your long-term bucket. Stock ZYX, you made $250. You held it for, say, 2 years and you decided to sell it. Stock XZY, or whatever the position is, doesn't have to be a stock, it could be an ETF or something like that. And you held it for a while and it just never did anything. So you lost $150. Your net long-term gains in this case is $100. So that's the first thing you do, is figure out your net loss, net gain of either, and short-term or long-term gains or losses, right? So they all add up together as a net. Then from there, you take the net of your short-term versus long-term results. So in our example, we have short-term net losses of $100, and we have a long-term net gain of $100. Our net total capital gain, assuming this is all we did, is a 0. This is the number right here that can reduce your ordinary income by, at the moment, $3,000 a year. So if you did all of that and you tallied it up to a loss of $5,000, what happens? You can take the $3,000 off your ordinary income, but you still have $2,000 left over. That can carry forward to the next year. And if you theoretically would use it in that year to either offset existing gains or just report it next year. What if the number was like 50,000? And because you had crypto or something, you had you bought Roku, right? What a horrible year for that. Carvana, you fell for all these stocks and they just fell apart. If you have $50,000 in netted out short versus long-term gain losses, then you can take $3,000 this year, $3,000 next year, $3,000 the year after, the year after, the year after, the year after, the year after. Now, a lot of people say, Dustin, this is stupid. I'm going to have $3,000 in capital losses for years and years and years. Well, it's not stupid. It's stupid until Donald Trump does it. Then my phone rings off the hook and they're like, Dustin, how does he get away with it? He didn't pay any tax. Well, it doesn't have to be a stock that you lose money on. It just has to be an asset that you lose money on. So there are businesses that he started where he lost money. I think he did an airline company. I know he did a water company. There's these things that he's done that just didn't work out. And people want to make fun of him or whatever. But at the end of the day, he gets to write it off against all the things that did work. So love him or hate him, that's the tax code as it works. Okay, so people look at that and they say, if I have $50,000 in losses, that's going to take me forever to get that that's 10 plus years. That's 15 years of having capital losses at $3,000 a year. Well, remember, you are using the losses to offset gains first. So if there's a year where you have a $10,000 gain, well, now you're going to draw from your losing bucket. And of course, that won't take you 10 years to draw that down. So what we hope is, okay, this was a bad year. And yes, you have losses, you're going to carry them forward. But maybe next year's a great year, or 5 years from now is a great year, and you suck up all of those losses to offset gains in a future year. That's the idea behind that. So I hope that helps. Just maybe a faster way to just go piece by piece and just help you out and see what you think. Yeah, that's about all we got here. I'll wrap it up there, finish up the old fashioned, and we'll see you on the next one. I hope you're liking these Jazz After Dark video series where we can just kind of hang out. Eventually, I'd like to do them live and just hang out with you guys for the evening. Until then, enjoy the rest of your evening, and don't forget, jazzwealth.com/2023. You can actually download all the important numbers, all of those capital gains and loss numbers, your tax brackets, when you phase out of Roth IRAs, your Medicare numbers, modified adjusted gross income. It's all on 2 pages, and it's free for you. You can have it. We won't sell your email or do anything crazy like that. You're just welcome to have it, and hope you enjoy.